A story is now circulating that a $12 trillion fund is panicking about silver and scrambling for nearly 2 billion ounces after an ETF redemption wave. The numbers that can be verified tell a different, more precise story. And it is more important because it reveals where silver market stress actually forms. Inside the plumbing of exchange-traded products, authorized participants, custodians, and the thin line between paper liquidity and physical metal. BlackRock is not a silver mine, and an ETF sponsor does not wake up one morning and decide to find ounces. What BlackRock does operate is a distribution and product platform large enough to concentrate flows, and in silver, those flows can become large relative to annual mine supply. At the same time, the modern silver market is not organized around one vault or one exchange. It is organized around multiple pools of inventory and multiple claims on inventory, and the most visible part of that system is often the least revealing. If you want to understand the real risk surface, you have to separate three things that are often blended into one: the size of BlackRock as an asset manager, the size of SLV as a physically backed silver product, and the global inventory footprint of silver, ETPs, and vault networks that sit behind settlement, leasing, and industrial procurement. Start with what is directly observable. The iShares Silver Trust, known by its ticker SLV, publishes the ounces in the trust and the basket mechanics. In early 2026, the trust reported a little over 500 million ounces of silver held for shareholders, with the figure moving day by day with creations and redemptions. That single product is therefore comparable in scale to a very large fraction of annual mine production, not because it produces silver, but because it warehouses silver as a financial wrapper. The next reference point is the global silver balance. Published survey data for 2024 put global mine production at a little over 800 million ounces. Published survey data for 2024 also put total demand at roughly 1.16 billion ounces, with a structural deficit measured in the hundreds of millions of ounces accumulated across multiple years. Those numbers matter because they set the stage for why ETF flows can become destabilizing even when they appear to be just financial. When a market runs repeated deficits, it becomes increasingly dependent on above-ground stocks, recycling flows, and the willingness of existing holders to part with metal at prevailing prices and terms. In that world, an ETF is not merely a passive mirror of price. It is a mechanism that can pull metal into financial storage during inflow episodes and release metal back to the market during outflow episodes. That release can look like relief, but it can also look like stress, because the metal does not automatically travel to where the tightness is. It travels to the entities that can redeem baskets, and then it moves through dealer networks, refiners, fabricators, and vault operators depending on incentives, premiums, and constraints. To understand why redemptions are not a simple story, you have to look at what an ETF redemption actually is. SLV is structured so that large institutional intermediaries called authorized participants, often major banks or broker-dealers, can create or redeem shares in large blocks, called baskets. When demand for shares rises, authorized participants can deliver physical silver to the trust, receive newly created shares, and sell those shares in the market. When demand for shares falls, authorized participants can buy shares, redeem them with the trust, and receive physical silver out of the trust. In other words, the ETF is a two-way valve. It can convert investor demand into bullion demand, and it can convert investor selling into bullion supply. This is not a theory. It is the core function of physically backed commodity ETPs. But the crucial detail is that the conversion happens in large, discrete units and through a small set of intermediaries. In early 2026, the published basket amount for SLV was about 45,000 ounces per basket, which means large shifts in shares outstanding translate into large flows of bullion. If you redeem 10 baskets, that is roughly 450,000 ounces. If you redeem 1,000 baskets, that is roughly 45 million ounces. Now scale that to a market where annual mine production is a little over 800 million ounces, and industrial demand alone is in the high hundreds of millions. Even without drama, the arithmetic shows why ETF flows can matter. The next step is to place that arithmetic into history. Silver ETP holdings did not always sit above 1 billion ounces. They grew into that territory in the years around the pandemic in the early 2020s when macro conditions, retail participation, and price volatility pushed large volumes into precious metals products. Survey data recorded that global silver ETP holdings reached record levels above 1.1 billion ounces at year-end 2021 and briefly climbed above 1.2 billion ounces in early 2021. Those are global totals across issuers, not one fund. They establish an upper bound for what ETP silver has looked like in the modern era. That is why claims of a sudden scramble for 1.9 billion ounces by one product or one sponsor should be treated carefully. It is not that the silver market is too small for billions of ounces to matter. It is that the documented scale of the ETP category itself sets a reality check. A large redemption wave can be historically large and still be measured in tens of millions or low hundreds of millions of ounces, not in multiples of the entire global ETP footprint. So if the 2 billion ounce claim is not a solid reference, what is the real story worth documenting? It is the story of how a very large pool of financially warehoused silver interacts with a physical market that is structurally tight in some segments and periodically loose in others, and how the stress can emerge not from outright scarcity everywhere, but from mismatches between where silver sits and where it is needed, in what form and on what timeline. Silver is not just silver. The market is divided by bar sizes, purity, fabrication requirements, and location. Industrial buyers do not consume a claim on silver. They consume specific forms of silver embedded in specific components, from electrical contacts and solders to pastes used in photovoltaics and electronics, and those uses are driven by manufacturing cycles and policy-driven build-outs that do not pause just because investors rotate portfolios. This is why modern silver analysis must always track composition. Published 2024 data showed total silver demand around 1.16 billion ounces, and industrial demand at a record level, with strength in electronics and electrical applications. That is a critical contextual fact. If industrial demand is strong, while some discretionary categories soften, then the marginal availability of metal for investors can behave differently than in a purely financial commodity. In that environment, ETF redemptions can appear to add supply, but if that supply is not delivered into the right part of the chain, the market can still register tightness through premiums, lease rates, and the behavior of visible inventories. This brings the focus back to the phrase panic. Markets rarely panic in a single direction. What they do is reprice the cost of immediacy. The cost of immediacy is expressed through spreads, through the premium for delivery in one venue versus another, through the willingness of holders to lease metal, and through the ability of warehouses to convert eligible metal into deliverable metal on short notice. The visible part of the market, the part investors watch on screens, is the futures curve and the ETF share price. But the physical system that supports those screens is a set of vaults, bars, and logistics constraints. The London bullion system publishes vault data that shows how much silver is held in Londonvaults offering custodian services, and those totals can move month to month. The US future system is backed by exchange warehouses with categories like registered and eligible, and those inventories can also move. The Shanghai system, the Indian import pipeline, and private vaulted stocks operate in parallel. None of these pools is automatically fungible with the others in real time. So when people say ETF metal will cover the deficit, the practical question is not only how many ounces exist, but which ounces, where, and in what form. Now layer in the behavior of financial institutions. Authorized participants are typically large dealers. When they redeem shares, they receive bullion. What happens next depends on relative pricing and balance sheet incentives. If physical premiums are high in one region, bullion may be shipped or swapped into that region. If lease rates rise, bullion may be leased rather than sold. If there is demand from mints and fabricators, bullion may be sold into that chain. If the market is in a risk-off mode and dealers want to reduce commodity exposure, bullion may simply sit in a vault under a different owner. The redemption itself does not guarantee new supply reaching industrial demand. It guarantees a transfer of ownership from a trust structure to an authorized participant in exchange for shares. That is a subtle but decisive distinction. It is also why a redemption wave can coexist with signs of tightness. A redemption wave can be a signal of investor rotation out of a product, while tightness is a signal that near-term physical metal in the right location and form is still being bid. The market can therefore experience the paradox of ETFs selling and physical premiums rising at the same time, because they are not the same market at the margin. The next part of the story is how big these flows can be relative to annual supply. Global mine production in 2024 was reported around 819.7 million ounces. SLV alone, at over 500 million ounces in trust, is therefore a stockpile comparable to well over half a year of global mine production. Global ETP holdings at their peak around early 2021 exceeded 1.2 billion ounces, which is roughly 1.5 years of global mine production at 2024 rates. Those ratios are not a prediction. They are a structural fact about how large the financial stockpile became. When a stockpile of that size exists, the market's marginal dynamics change. Price is not determined only by mines and factories. It is determined by the willingness of that stockpile to remain warehoused versus to be mobilized. Mobilization can happen via redemptions. It can also happen via lending and leasing, or it can happen via outright sales and over-the-counter markets. The issue is that mobilization is not frictionless. It requires intermediaries willing to finance inventories, hedge exposures, and warehouse metal through volatility. In periods where risk appetite falls or funding conditions tighten, The willingness to intermediate can decline. That is when the system can feel like it is running out of silver, even if large tonnages exist, because what is running out is the willingness to transform stocks into immediate, deliverable supply under stress. This is why the most useful way to interpret BlackRock silver panic is not as an emotion, but as a proxy for an institutional stress scenario. A situation where heavy selling of ETF shares triggers large redemptions, which forces bullion out of a trust, which then forces dealers and custodians to manage logistics, hedges, and collateral under volatile conditions. In that scenario, pressure is not borne by the ETF sponsor in a simple sense. Pressure is borne by the intermediaries and the market makers who keep the ETF tracking the underlying. If the ETF begins to trade at a persistent discount or premium to its underlying metal value, that is a sign that the arbitrage mechanism is strained. In early 2026, published data for SLV showed periods with noticeable premium or discount readings. In normal times, those tend to be small because arbitrage is active. When they widen, it tells you something about frictions. Another layer of pressure comes from the broader macro environment. A rising rate environment changes the opportunity cost of holding non-yielding assets and can contribute to outflows from metal products. But it also changes the cost of financing inventories. For a dealer that holds physical silver and hedges it in futures, the economics depend on funding rates, repo conditions, and the spread between spot and futures, along with lease rates. When funding costs rise, or when balance sheets are constrained, the dealer may be less willing to carry inventory. That can reduce liquidity. Liquidity reduction can amplify price moves during heavy flows, both on the way in and on the way out. So a redemption wave is not merely a flow, it is a test of liquidity under balance sheet constraints. The story becomes even more complex when you consider the industrial side. Published survey work described silver's fourth consecutive structural market deficit in 2024, and it framed the combined deficits across 2021 to 2024 as a very large cumulative shortfall. A cumulative deficit implies that some pool of above-ground stocks has been drawn down, or that recycling and disinvestment have been higher than they would otherwise be. In the early 2020s, large ETP inflows built a financial stockpile. In later years, outflows released some of that stockpile. If industrial demand is strong, then one interpretation is that disinvestment and recycling are playing the role of swing supply. That is important because swing supply is not guaranteed. It depends on behavior. It depends on whether investors view lower prices as a reason to sell or a reason to hold. It depends on whether institutions face margin calls or rebalancing constraints that force sales. And it depends on whether physical holders are willing to part with metal when they believe future demand is rising. In that sense, an ETF redemption wave is a behavioral event as much as a mechanical event. It reflects a shift in willingness to warehouse silver inside a financial wrapper. The market impact depends on where the released metal goes and whether it is absorbed by industrial channels, other investors, or by other forms of inventory. There is also a geographic dimension that matters for any claim about scrambling. Silver is globally traded, but local conditions can still drive segmentation. Industrial demand is not evenly distributed. Refining and fabrication capacity is not evenly distributed, and trade flows can be affected by policy, tariffs, and shipping constraints. The result is that a large pool of metal in one location may not relieve tightness in another location quickly. Londonvault totals can rise while U.S. exchange inventories fall, or vice versa. An ETF can release metal while premiums in coin and bar markets remain high due to fabrication bottlenecks. It is entirely possible for the system to show more silver somewhere and not enough silver here simultaneously. That is not a contradiction. It is the normal behavior of a commodity with multiple forms and multiple end markets. Now connect all of this to the concept of hidden stocks. Visible stocks are those published by exchanges and certain vault systems. Hidden stocks include private vaulted holdings, industrial inventories, and metal held within supply chains. ETP holdings are semi-visible because they publish bar lists and total ounces. But even there, the market sees totals and does not automatically see the path of bars once they leave a trust through redemption. If a dealer redeems and then uses that metal as collateral, leases it, or swaps it in an over-the-counter transaction, the final destination may not be transparent to the public. This creates fertile ground for dramatic narratives. But the more disciplined approach is to acknowledge what is visible and what is not, and then to track the stress markers that are measurable. The measurable markers include ETP holdings, changes in shares outstanding, premiums and discounts, reported vault totals in major hubs, and the published supply-demand balances. From those, you can build a causal chain without relying on unverifiable claims. The causal chain in a redemption episode typically runs like this. First, a macro or market catalyst shifts investor preferences, producing sustained selling of ETF shares. Second, market makers and authorized participants absorb the selling and, when it becomes economical, redeem shares for physical bullion. Third, bullion is transferred out of the trust to the authorized participant, reducing ounces in trust and reducing shares outstanding. Fourth, the authorized participant decides what to do with the bullion based on pricing, funding, and client demand. Fifth, if bullion is sold or shipped into markets where it is needed, it can relieve tightness. If it is withheld or diverted into collateral and leasing, it may not. Sixth, if the redemption wave is large and fast, it can overwhelm the capacity of the market to smoothly absorb the flows, causing premiums, discounts, and spreads to widen. Seventh, those frictions can feed back into price volatility, which can then influence further investor behavior. That is the mechanism. Notice what is missing. An ETF sponsor, scrambling. The sponsor administers the trust and publishes reports. The scramble, if it exists, is in the dealer network managing metal under volatile conditions. The next question is why this matters for 2026 specifically, rather than being a generic ETF story. It matters because published silver market data suggests the industrial component remains high, because the market has experienced multi-year deficits, and because the modern silver investment complex has created a stockpile large enough that its mobilization or immobilization can change marginal availability. In a market like that, a redemption wave is not just a reflection of price. It can become a driver of the short-term physical balance by releasing a large quantity of metal over a short window. But the release is conditional. It is conditional on the arbitrage function remaining intact and on dealers remaining willing to intermediate. If funding conditions tighten at the same time as redemptions accelerate, the system can experience a dual stress, financial selling pressure and reduced intermediation capacity. That dual stress is where language like panic comes from, even if it is not a precise description. It is the feeling of a market where the normal shock absorbers are stiffening. To see how big the shock absorbers are, return to the numbers that are documented. Global silver mine production in 2024 was just under 820 million ounces. SLV in early 2026 reported over 520 million ounces. Global silver ETP holdings reached a record around 1.13 billion ounces at the end of 2021, and briefly about 1.21 billion ounces in early February 2021. Total silver demand in 2024 was reported around 1.16 billion ounces, with industrial demand around 680.5 million ounces, and a structural deficit around 148.9 million ounces. Those numbers together define a system where the investment stockpile is large, the industrial baseline is large, and the supply growth is limited by the fact that silver production is heavily tied to byproduct output from other metals. That last point matters because it constrains how quickly the market can respond to price signals by increasing mine output. If silver were primarily mined as a standalone product, high prices might incentivize rapid expansions. But when a large portion of supply comes as a byproduct from lead, zinc, copper, and gold operations, silver supply responds more slowly and indirectly. That is part of why above-ground stocks and financial stockpiles play a larger role. Now consider what happens if outflows accelerate while price rises instead of falling. This is another scenario that makes headlines. Prices move up, but ETF investors sell anyway, perhaps rotating into other assets or taking profits. In that scenario, the market can face a unique tension. Rising spot prices can coexist with ETP outflows. Outflows release metal, but they also indicate that financial demand is not the driver of the price at that moment. If industrial demand, OTC demand, or other forms of investment demand are strong, the released metal can be absorbed. But if absorption is uneven, the market can become segmented. This is when you might see large volumes moving through one hub while another hub shows tightness. Londonvault totals might rise while exchange deliverable inventories decline, or the opposite. The public, watching only one series, might think something impossible is happening. In reality, it is the same mismatch problem. Another reason this story matters is that it illustrates the limits of using a single number to represent silver available. Even if the trust reports 520 million ounces, that does not mean 520 million ounces are available for industrial use tomorrow. Those ounces are held for shareholders. They can leave through redemption, but redemption requires market participants willing to execute the arbitrage and then distribute the metal. Similarly, even if global ETP holdings once exceeded 1 billion ounces, it does not mean that those ounces are a standing inventory for the industrial system. They are a reservoir that can be tapped, but tapping depends on price and behavior. The reservoir can also refill during periods of inflows. The net effect over time can be large swings in where above-ground silver sits. That movement is one of the defining characteristics of the 2020s silver market. At this point, it becomes possible to restate the story in a factual way that retains the urgency without relying on exaggeration. The story is not that a $12 trillion fund is desperately seeking 2 billion ounces. The story is that the world's largest asset manager operates the largest physically backed silver ETP, that this product holds over 500 million ounces of silver, that global ETP holdings have reached and sustained levels around or above 1 billion ounces in recent years, and that changes in investor positioning can mobilize or immobilize metal in quantities large enough to matter relative to annual mine supply. The story is that the silver market has run structural deficits in multiple consecutive years, that industrial demand has hit record levels, and that the market is increasingly dependent on above-ground stocks and on the behavior of financial holders to meet marginal demand. The story is that redemptions can release metal, but they can also expose the market's dependence on intermediaries and on funding conditions, and that this dependence is a source of fragility that does not always show up in headlines. Finally, the story is that reported inventories are only one slice of the total system, and that the most important question in a stress episode is not merely how much silver exists, but how quickly it can move to where it is needed, in the form that is needed, at the price and terms that clear the market. In 2026, if volatility remains elevated and the macro environment remains uncertain, ETF flows may continue to be one of the most visible and most misunderstood drivers of short-term silver market conditions. You can measure those flows. You can track ounces in trust. You can track changes in global ETP holdings. You can compare those figures with annual mine supply and with published demand. You can then watch how the market expresses tightness through the cost of immediacy rather than through a simple running out narrative. The silver market is a system of stocks and flows. Mines and recycling feed the flow. Industry consumes the flow. Investors move stocks in and out of reservoirs. Vaults and exchanges publish partial snapshots of those stocks. When the reservoir is large and the flow is tight, the reservoir becomes a critical variable. That is what the modern data shows. That is why the most useful way to interpret a redemption wave is as a stress test of the system's ability to transform financial selling into physical redistribution, without breaking the link between paper prices and physical reality.